Welcome to Equity Matters, Navigating Equity Compensation, a webinar series hosted by Countsy. Today, we have a special guest, Bruce Brumberg. In conversation with Marcini from Countsy, Bruce is editor-in-chief and co-founder at mystockoptions.com. In the next 30 minutes, we'll dive deep into how tax season impacts employees with company-sponsored stock plans and share expert strategies for clear, effective communication. Bruce will also reveal his top tips and tricks for making complex stock plan concepts easy to understand, whether for employees, consultants, or finance teams. We hope you enjoy this conversation, and Corrine, now over to you.
Well, thank you. Excited to have everybody here and excited to have Bruce here, a longtime friend and colleague and someone I've learned a lot from over the years. And of course, we have Marcini here from Countsy. And today we're going to talk about tax matters. It is March 11th today, so you all have about 5 to 6 weeks left to get things done if you're not going to file an extension. So this is the crunch time. So today we're going to kind of organize this in kind of 4 sections. We're going to talk first a little bit about reporting requirements, both what the company needs to do and what the employee needs to understand. And then we're going to talk a little bit about private companies and specific things to private companies and employees and taxes. And then we're going to talk about public companies or listed companies and some of their issues. And then at the end, I've got a number of interesting questions to ask Bruce and Marcini in terms of working with employees and as somebody who might be at the company. So let's get started and let's talk about reporting requirements. So many people, you think everybody understands the difference between a W-2 and a 1099, but let's talk very briefly. Maybe Bruce, just tell us a little bit about the difference and what if you get both of these things in the mail, what should you do?
Well, W-2 is almost like iconic. People know what that is. That has all your compensation income in it, on it, including the equity compensation income that's going to be part of that box 1 number. I mean, sometimes people get confused because also companies, if they have non-qualified stock options, they report it in box 14 and also maybe in box 12. So one mistake, I'm giving you a tip early on, is make sure you don't double report that income. So it's really the number that's in box 1 where the compensation is on the W-2. Now the 1099, that's one of those terms that I would be careful using sometimes because there's a lot of 1099s. You get a 1099 for interest, you get a 1099 for a lot of other purposes. So I would just more think of it as the broker statement for stock sales. So just, that I would simplify the lingo. Maybe internally use, the 1099B, because that's really the official form. In fact, even the 1099B, if you look at the official form, very few brokers actually use that form. They take that, they reformat it into, a statement that's has the same box numbers for the columns, but it doesn't even look like the 1099B that is the official IRS form if you Google it.
All right. And if you're working for a private company, Marcini, you might get a 1099 because you're not an employee, right? So you might be getting something like that from your employer.
Absolutely. If you're a consultant, obviously you'll be getting a 1099 at the end of the year. As it pertains to equity, you'd be getting a 1099 if you were granted some options and there was some spread or some gain while you were a consultant. Generally speaking, though, if you're an employee of a company, any compensation matters related to equity are reported on your W-2.
Okay.
I'm sure there are some exceptions, but generally speaking, they're on your W-2.
And that's another example where the 1099 gets confusing. Like if you have an independent contractor, it's now on the 1099 NEC, and that would include, board members too in a public company. It's 1099 NEC. Well, you have all these other 1099s as I was mentioning. A company, if they were repurchasing the stock, let's say in a tender offer or company-sponsored liquidity program, so that's kind of popular for the larger private companies, then they would probably issue a 1099B that's coming from the company.
Okay. So I'm just going to emphasize, be careful not to double count your compensation. You might get multiple forms. It doesn't mean you add them all up. So be careful on that. Okay. Now, what if you get a 3921 or a 3922, maybe Marcini? What if you get one of those things in the mail? And I'm really talking to the employees here or the consultants. What do you do then?
Well, a 3921 is a reporting statement. You don't actually need that for your tax return because you've had no reportable gain. So every private company that has an employee exercise an ISO during the year is technically supposed to send them a 3921, and that just talks about what the fair value, what their strike price was, and what was the fair value on the day they actually exercised. So it's really only if you exercise your shares you'll get that. You do not need to report that gain on your annual tax return, because it's not a taxable event yet, as we know, and ISO is not taxable until it's actually liquid. 3922, Bruce, that's a form that's sent when it's an employee stock plan, right? Like for a public company.
ESPP.
Yeah.
So, for the ISO, it's the 3921,
Mhm.
and for the ESPP, it's 3922. I sometimes get them confused. So the way I remember it is like 21 is a 1, and that looks like an I. So that's how I know that applies to the ISOs. That's how I keep it straight in my mind. But yeah. I mean, and private companies have to do it too, and it's very useful to save it, because years later, you may wonder what was really that exercise price. And also, if you have ISOs, just realize the IRS is going to get that form. It's an information return. It's not something that you necessarily have to report on your taxes right away, but you do want to do that AMT calculation. So if there's a big spread between that exercise price and the fair market value and the date of exercise, you may trigger the AMT. So that form is very helpful for that.
And as regards the actual ability to create that form, most of the systems have the ability to do those 3921s, because a lot of the smaller private companies really are not equipped to start sending out various tax forms. So if you're on like a Carta or another system, a Captiva, you should be able to actually whether it's an upsell to get the licensing, to actually have that form created by the system. It's always good to do that, so you're like avoiding any kind of errors on input, etc.
Okay.
Yeah, and then the company has to file it too, and the deadline's a little different for whether it's electronically or a paper filing. But you get it to the employee usually by the end of January, beginning of February of the year after exercise, or with the 3922 of purchase.
Right. All right, we'll talk about AMT in a little bit, but last topic under reporting requirements, this would be more for the company administrator, is we think a lot about the IRS and federal forms and all of that. Just maybe, Bruce, touch on state reporting, that what are some responsibilities there that someone might have?
Well, that's obviously a really hot topic right now, because states are hungry for revenue. And so, those states where an employee lives or works, even if it's just during, part of the period, you may have to have reporting responsibilities in that state. So you really have to look into it. You have to see if there's any, tax agreement between, different states that may say you only have to report it in one state. But the whole area of mobility, and some larger companies even have like tools that use mobility tracking to follow employees around. So, that's a whole nother set of requirements, and it is complicated. And also, companies can sometimes, put all the income on the W-2 for one state. I was recently looking at a situation like that, where someone had moved, between states, but for some reason they put all the income for the W-2 that we filed at the state as if the person was in New York. And then there was a number of things that had to be done to change that, because the employee was in different states during the vesting period. And really, the income should have been allocated that way and not 100% to New York, which is a high tax state.
Really speaks to how there has to be a ton of communication between the equity administration group and the payroll group, because payroll probably knew about that change, because the employee probably logged onto their payroll system and changed their state for state taxes. So that's an important point, really, around communication between those two groups within the company.
That your system does that kind of tracking?
Yeah. If you're on some of the payroll systems for payroll purposes, it would, but not necessarily that information might never have made it back to the equity administration team.
Right, especially about the move. Yeah. And I think what Bruce said, I'm just going to reiterate it again. It's not for that year. It's for the vesting of the grant. So you might have had this grant for 4 years, done nothing for 4 years. Now it's the big day. You're going to get all your money. It's the big payoff. This is the year that you made that money, but you do need to look at where were you over the 4 years that you were earning the award. Is that correct, Bruce?
Yeah, well, it even gets more complicated, because let's say, a lot of private companies, X% vest after 1 year, then monthly thereafter. Mm-hmm. Like each vest could actually have a separate allocation for tax purposes.
And if it's a stock option versus restricted stock, so RSU. So let's move a little bit into that. Let's talk first about if you're working for a private company. So if you're working for a private company, just real briefly, maybe Marcini, can you tell us the difference between an ISO and a non-qualified, just in case people don't know the difference?
Sure. An ISO is a grant that allows you to get special tax treatment. So basically, like we just talked about, you're able to vest and exercise your share without having to actually pay tax on the gain. Whereas when you have a non-qual is typically granted to an employee or to a non-employee. That's not always the case. There are times when employees are granted non-quals, but in our world, most private companies are granting ISOs to employees. They're granting non-quals to non-employees, and non-qual has a less favorable tax treatment in that you do have to actually pay tax on the gain when you exercise. Bruce, I don't know if you have any other thoughts around that, but that's generally how we would classify them.
Yeah, I mean, another big difference is that, with the ISOs, there's no tax withholding and there's no Medicare or Social Security. If you know that people are going to exercise them right away, then it's probably better to do non-quals to grant, because you don't have to deal with some of the other ISO type rules. But if you think people are going to wait to exercise, then maybe ISOs can be a better, because you would only really have taxes if there was an AMT spread at the time of exercise.
And you're limited in terms of how many ISOs you can grant. And I always remind people, members of the board of directors are not employees. I'm always surprised how many people think they are, but they are not. So they do not qualify for an ISO.
Yeah, the non-employees can't get it. I mean, ISOs are a creature of the tax code. And so they're very, very specific requirements. There's this $100,000 grant date value rule, for example. So you can't have more than 100,000 that are exercisable that would vest in one particular year, which can be an issue in a private company down the road. Let's say if there's an M&A situation and the ISOs are accelerated. So ISOs have some advantages from a tax purpose, because when you sell it, and if it works out, everything is long-term capital gains over the exercise price, but it has a lot more complications.
Yeah, the other thing is you can only exercise an ISO 90 days after termination. So that's another thing. Sometimes private companies say, well, we're going to give you more time to exercise. And true, but you are going to lose the tax advantage after 90 days.
That's a really good point. Because there is a trend to accelerate, give you a longer period to exercise. And you got to make sure that, employees and their financial and tax advisors realize that could, they lose the non-qualified, it becomes a non-qualified stock option immediately. There doesn't need to be any communications. That's just the way it is under the tax rules, which may be a fair trade-off, because you're going to lose. Either you have to exercise options you don't think are worth anything, or they turn into non-qualified stock options, and then you can ride them out.
Yeah. That's super important, actually, because we're seeing a lot with private companies. Obviously, we're having a bit of a restructuring in the environment right now. And the CEOs and the board think, oh, we have to do a RIF, but it would be really nice to give people extra time to exercise without necessarily following in with all of that sort of stock plan education that's as a result of that decision.
Yeah.
And there's a whole accounting issues they have to look at too. Usually, it's not a big issue, especially if the value is less. But that's for another webinar.
Yeah. So what about an 83B? I always tell people I go to cocktail parties and I get pulled aside and someone's like, should I file my 83B? So what would you say? Explain that briefly to people and what your thoughts are.
Well, the big news for the 83B is there's now an official IRS form. I mean, it's not as big news as you becoming a grandmother, but there's now a form, because up until November, there was just IRS guidance on what you had to put into the form you file with the IRS. So now if you Google, 15620, it's actually a 5-digit form. There's a form you can fill out. So you have to file it with the IRS within 30 days of exercise, if these are early exercise stock options, or if it's a restricted stock grant. You can't do it for RSUs. You have to file it within 30 days of the grant, and then you're going to recognize tax when that property is sort of transferred to you. So the big thing is, if you think the stock price is going to go way up, then it's a great thing. And if these are LLC interests, the general practice is to file what's called a protective 83B. So for profits interest, you would also file that at grant.
With private companies, though, it is really important that every employee doesn't have the option to file an 83B. Like when they're granted that ISO, the board has to approve it for it's called early exercise. So I would say, generally speaking, we're only seeing 83Bs with very, very early employees. So just to set that expectation, every employee it isn't your choice necessarily to file an 83B. It has to be part of your grant document that you're allowed to do that early exercise.
Absolutely. That's a really good point. I mean, there's a lot of misunderstanding out there. People think every private company stock option grant is an 83B. 83B is almost, again, one of these generic terms, 83B option, and people don't know what it means, but yeah, exactly is what you're saying. It has to be in the grant agreement. It has to be part of the stock plan too. And there are many private companies who say it's just not worth it administratively. They walk the talk about, oh, we want employees to be owners. And an ISO with an early exercise would be a nice idea. But sometimes they think, well, I don't want to deal with the administrative issues, the complications. And so they don't grant ISOs. It's also regional. I find that like on the more West Coast companies tend to use the early exercise 83B type options. Then, I'm in the Boston area and there's not as many companies that do
I
that.
think there's a real administration tax, to use that term, on a lot of 83Bs because it has more people on your cap table, right? So once there's more people on your cap table, every time there's any kind of shareholder reporting, they have to be included in that. So like we generally caution our clients to be careful about using 83Bs too liberally. It just messes up that cap, messes up the offer, but it gets that cap table quite busy.
Oh, it makes it much more complicated. They're going to be common stock shareholders if you want. If you have different classes of stock, you have to decide what whether you truly want that. Although if it may be a situation where you bring in a senior person who's sophisticated, and that's what they want. They want to be able to join that company, and they want to be able to get options at a very low price and exercise it right away.
Yeah. And just two things I'd say. One is it is the personal responsibility of the individual to do this. It's not the company's responsibility. And with that 30 days that Bruce mentioned, you want to be really careful that you don't somehow volunteer to start doing this, because what happens if you mail it late? And I've seen that happen. And then secondly, one of the benefits of COVID, which by the way, today's the 5-year anniversary, is that I think now you can file these 83Bs electronically, where before you used to have to actually print a piece of paper and put it in an envelope. So that is also an advancement that the IRS has come up with. Anyways, on 83B, I think there's a lot more to do. And I always tell people at these cocktail parties or my nieces or whoever calls me, you need to get some advice about whether or not to do it. And as Morcini said, maybe you can't even do it. So let's move in. We're about halfway through. Let's start talking a little bit about public companies. And we touch on ISOs. A lot of times you don't see ISOs at public companies because you talked about that administration tax. But talk a little bit about AMT. Whoops, I think we lost Bruce there for a moment. So I don't know, Morcini, are you comfortable talking a little bit about ISOs and AMT and how those two relate, or should we wait?
I definitely would prefer Bruce, the tax expert, to be on to talk about that. But I guess the point being that for most employees, you may have an AMT impact if you've exercised an ISO. You might not owe tax. You might believe you don't owe any tax for the federal government purposes. But when you're going through your tax return, if your state has an AMT requirement, you do have to report it and pay over that AMT. So that's just something to be aware of, that even though it's an ISO, you may have it. And that's whether it's a private company or a public company, you may have an AMT requirement.
Right. And even if you're using QuickBooks to do your or TurboTax to do your tax return, it will ask you, do you want to run an AMT calculation? And you do need to run it. You need to compare. And I think it was several years ago when they were repricing and all these people were exercising options and making a lot of money. And then they didn't realize that they owed AMT tax. They thought their federal tax was fine. And then they had a surprise. So we'll come back to AMT.
And the thing about when you're doing your own taxes like that, to be aware of that. I mean, you have to be informed. So if you have some sort of complicated tax stuff around equity instruments, you're probably better off using an external advisor, or at least getting some advice, because TurboTax doesn't know. You can absolutely get through your tax return without committing that you had any AMT, and then afterwards end up with a tax bill.
Yeah. I just know it asks that question and you can ignore it, as you said, and you shouldn't ignore it. If you have a stock option, you just probably shouldn't ignore it.
Yeah. No.
Well, let's talk a little bit about them for public company reporting. We talked about the W-2. Can we talk a little bit about supplemental reporting and maybe explain a little bit about what that is and how it works?
Sure. If you have some sort of an ESPP plan at work, for example, and when you go to do your tax return, we've talked already about how that is reported in the W-2 as gross income. But when you go to do your tax return, your cost basis on the report, on the initial high-level report you get from your brokerage account, is not going to be correct. So you really need to not just take that 1099 that they send you that has a cost basis of, it possibly might have a cost basis of 0. Actually, generally speaking, you have to go onto your brokerage account and get a supplemental report. And that's the report you actually use when you're filing your tax return. Bit of complication there. You have to actually go line by line, typically instrument by instrument, and submit the actual cost basis correctly. So you don't end up double paying tax because it's already been on your W-2. Generally speaking, you've been taxed on it already. So you need to make sure you're not double paying tax. That's a bit tricky again. And I think I would recommend to anybody, if you're an employee, as opposed to say a stock plan administrator, if you're an employee, kind of spend some time on your brokerage account and look at all the different reports that they can send you at the end of the year. Because it isn't just that 1099 that they send you, that 1099B or whatever. You do have to have that supplemental report.
Yeah.
Some of the, like TurboTax and some of the automated tax return systems allow you to upload that supplemental report. I have generally found that you're better off typing it in yourself.
Oh, interesting. Another good tip. Yeah, and I find it, just to talk about ESPP for just a moment, for mostly public company employees, but there are some private companies that have ESPPs. You really need to understand how that plan works, because you've already contributed a significant amount of money that was already taxed. And so you're really only paying on the gain. And you need to understand that it's the gain, not the whole amount that when you sold the stock.
Exactly. Yeah, and you need to be really careful with the ESPPs that way.
Yeah. Well, maybe let me ask you a few questions while we wait for Bruce to come back. So what's the difference, do you think, between advice and education? And where do you think an employer needs to sit in all of this?
Yeah, I mean, you have to be very careful here, right? Because you can't really advise people on what their tax situation should be. Like, you shouldn't really advise somebody, oh, you're allowed early exercise, you should file an 83B. That's sort of advice. As opposed to education, you've been granted an option that you're allowed to do early exercise. I would suggest you go investigate whether it makes sense for you to file an 83B, check with your own tax advisors. So it's a little bit different on the language. We're pretty careful, both at County and when we're in that role of stock plan administrator, that we're not technically advising people, but we're absolutely pointing them towards the right sort of education resources.
So whether it's County or whether it's the employer, you do think the employer needs to provide some information, not to say, I can't tell you anything because I'm not your tax advisor.
Of course, they should direct them to certainly some education around what is an ESPP plan, what is the kind of stock instrument you've received, direct them to where they can find out about an 83B. They just can't advise what to actually do in your particular tax circumstances.
Right.
Yeah.
And I think
there's so much education out there around stock and stock plans. I mean, Bruce's website, for example.
Yeah.
Maybe you can repeat what it is for Bruce Crean, since he's not here. I've been on that website and it's got some excellent resources, whether it's webcasts or just like links that you can just go and read up a little bit. And of course, in today's world of AI, you can find out anything you want with one type into a ChatGPT type product.
Right. Yeah. And it is mystockoptions.com. And what I find interesting about Bruce's site, I'll make a little plug for him since he's not here. And apparently his phone lines are down, so something must be happening in Boston. Is that it's great education that an employer can license to make available to their employees. So for those of you who are on the company side saying, well, I wouldn't even know where to find this information, this is where this information is held, and you can make it available to the employees. Also, a lot of the wealth management firms have a lot of education and information that they can provide. If you're publicly traded, you're probably working with somebody on that. So talk to your client relations person and say, I think I need some information that I can make available to my employees. And then many of the wealth management firms actually license mystockoptions.com. Yeah. So definitely.
Exactly. So we would encourage you as an employer to provide some sort of education for your employees, as opposed to just being very hands-off, because your employees could end up in a bad situation. And nobody wants that, right? You want to give them, the whole point is compensation. You want people to be compensated and to feel compensated and to be tax efficient around that compensation. So it's pretty important that you do have some resources available to them.
Right, right. So what do you think confuses employees most when you're getting phone calls, inbound calls? What are they most not?
Well, different issues between private companies and public companies, obviously. And I would say almost the stakes are higher in public companies because it's immediately liquid.
Yeah.
So if we think about public companies, initially, I think employees get confused, especially around that ESPP thing. It can be very confusing. The grant has actually shown up on your W-2 already. You've probably been taxed on it. Then you come to the end of the year, you pull your report, and suddenly your cost basis is almost zero or very, very low. It's very difficult to understand, to navigate your way through that. So just sort of, I always say, take a few deep breaths, go look for that supplemental report, think through it, and if you're not working with a tax advisor and you're doing it yourself on an automated tax system, it's possible to do it, but you just have to really just think through it and make sure you're putting that cost basis. Listen, what's the important thing? The gain. So make sure you have the right cost basis and you have the right gain, and that's what you're going to pay tax on. So I do think that's kind of a bit complicated for public company employees. Although I do also think the public company employees have a lot more resources. They tend to have a more professional administration team. They tend to have a more professional sort of compensation team. In a lot of private companies, the cap table and the equity is very sort of opaque. It's very unclear who's responsible for it. Like typically in a private company, especially at the early stage, the CEO and the lawyers look after the cap table. It's not typically your finance department that are running it. They might have access to Carta, but it's typically the lawyers and the CEO. And the CEO is not that up for you calling the lawyer at $750 an hour to ask a question.
Yeah.
So I do think it can be a little bit confusing for private companies, although, like I say, because they aren't immediately liquid, if you have the right type of instrument, you shouldn't have a tax situation. But I do think, listen, you either have an ISA or a non-qual. Certainly there are companies that do RSUs or other kinds of stock instruments, and the taxing is different. But like I say, educate yourself, get onto ChatGPT and just ask it, what's the difference between these three things? Make sure you understand what you have, particularly look at your paperwork, look at anything the company has sent you and understand your gain. You're only paying taxes on the gain.
Yeah. Yeah. And you're only paying taxes on $1 of income once. So make sure you haven't done it already. Now, for private companies, what about tender offers? We haven't talked at all about that. Seems to be popular. What should people understand there?
Yeah, I mean, I think the tender offers that we've been involved in, there is actually a lot more education, Corinne, because when you're doing a tender offer, you're typically using another brokerage firm or some sort of a system, like whether it's secondary or whatever. So there does tend to be some education. You're going to have a gain. So a tender offer, if you're selling your shares, is almost as if you got acquired or if you went public. It's kind of the same thing. So if you're actually selling shares, you're going to have a gain. So be aware you're going to have a tax situation. And the company, when they're doing those tender offers, will typically have done a lot of consulting with their tax firm on whether that should be compensation, gross compensation, or whether it's long-term capital gains. And of course, long-term capital gains is better than the opposite, like whether it should show up as a compensation. But I would say that in tender offers, employees tend to get a lot more information and they will get that reporting. Because at that point, even though it's still private, it's still with sort of an institution that's really managing that process.
Right, a broker dealer. Yeah.
We've generally found that in tender offers, they're fairly organized and people are pretty comfortable with what's happening and what the employer has to report on the W-2 versus what the employer is going to report in some sort of another, whether it's a 1099 or whatever.
Yeah. And I'll make my pitch here for tax planning as well. So we've been talking about a very reactive thing. You've sold something, now you need to pay tax. But I do think if you have these instruments, if you've been awarded these shares or whatever you've been awarded by the company, and sometimes it is a cash unit as well, maybe it may not be equity, do talk to somebody about when should I exercise this? When should I take the income? A lot of it has to do with your personal situation. Are you nearing retirement? Are you young? Are you about to have children? When do you need the money? There's a lot of conversation that needs to happen. And I always worry about people thinking there's a formula for it. And there's not. You really do need to chat with somebody. And it's not going to be, as you said, your company person. You need to get somebody out there. And they're, as you said, Google tax advisors. You'll find plenty. Well, this was really helpful, and we promise to keep these to 30 minutes so that you can get a lot of quick information and tips and hints before you spend your whole day with us. Sorry we missed Bruce. I'm sure there's some technical issue there. We're looking forward to seeing everybody in April. We've got a real treat. We've got Barb Boxka, who's going to join us. Most of you probably know her. She's the executive director at the National Association of Stock Plan Professionals, or the NASPP, and she is an expert on stock plan expensing. So this is really great for company administrators and financial experts. Todd Marcus from Countsy is going to be joining us. He is an expert in this area as well. So Barb and Todd are going to talk about what you need to understand, what are the new things that are happening in the world of expensing, and maybe how you can manage the expense for your company. And maybe there's ways that you can actually reduce that cost for your company, which would be great. So we'll be having that webinar on April 8th. And I want to thank Martini and I want to thank Bruce for joining us. And go to mystockoptions.com if you want more information on this. And as always, we do save these webinars on YouTube if you want to share this with your friends or colleagues if you found this helpful. So thanks again, and we'll see.
Thanks, Corinne. Looking forward to seeing Barbara and Bruce. Appreciate your time today.
Yep. Thank you.
Talk to you soon.
We thank you for joining us, and we hope you enjoyed this webinar with Bruce, Martini, and Corinne. For more information, please scan the QR code for their LinkedIn page or visit us on countsy.com. Stay tuned for our upcoming webinars. On the 8th of April, we discuss trends in stock plan expensing with Barbara Baxa, Executive Director at NASPP, and Todd Marcus from Countsy. And on the 12th of May, we will discuss the private market and how it can benefit your employees with Tom Callahan, CEO of NASDAQ Private Markets. Please follow us on our LinkedIn page for any updates on the upcoming webinars. We are looking forward to seeing you at our next webinar. From all us at Countsy, thank you again and have a good rest of your day.